Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael and we are continuing today with a meta deep dive and also a comparison with the other Magnificent 7 stocks. So let's continue where we left off in the last video. This is the price earnings last 12 months, so backward looking for Nvidia, and it's currently at 38 times. And as we said in the last video, that is not actually very expensive considering the high growth rate. The question, however, is that they have very high gross margins. That is both a sign of quality and a well-run company with strong product line, but it can also long-term be a risk because it's pretty rare to have that type of high margins for a large company over the long term because it attracts competition. So right now, the gross profit margin for the last quarter is 73%, and for the rolling 12 months year, it's 75%. Sure, we have a really nice trend here in increasing gross margins, but as you can tell, it has potential to crash down if you have any trouble in production or deliveries or input costs. Just a 10% drop from 75% to 65%, which would be around here, which would fit into long-term trends, but adjusted for that this might be just a temporary peak now during this AI frenzy build-out. Just a 10% drop from 75% to 65%, still very high numbers. The net income margin would also drop by about 10% from 55 to 45%. And that's almost a 20% drop in profits. And if that would be a permanent change, that is a 20% drop in fair value. And I would say that Nvidia is pretty much fairly valued here at 109. I would be a buyer at 75, I've said before, and more of an eager FOMO buyer at perhaps $50 per share. But today it's not really about Nvidia. It's trying to show Meta in the context of other successful mega caps. My 4-year price guess for Nvidia based on a calendar year, and this is important, what is a calendar year and what is a financial year, but a calendar year 2028 EPS of, well, basing it on my own forecast of 7.25 for 27 times 20% growth for 2028, calendar year 2028, takes us to $8.7 per share. And let's say they can be valued at 20 times that at the time. That would take us to $175. The question here is, how much can Nvidia actually grow? Can they keep their lead, or is this more or less a manufacturing company that has, even though the manufacturing lies at TSMC and not within Nvidia's own company? Anyway, 20 times earnings at the time, that might be a bit on the low side. I mean, again, look at their historical valuation numbers. Going as it's only really once they got below, and 20 times, I mean, it leaves plenty of upside potential at least. But at 20 times, we would get to a share price at 175, or a CAGR of just 12%, so 12% annual returns. That is definitely not good enough. So, but again, that hinges on this 20 times earnings projection in terms of backward-looking price-earnings ratio in 2028. It could just as well be we are in a new bull market, that Nvidia has innovated and strengthened its lead even, that the build out of AI is actually just then coming into the sweet spot. So we could, but I wouldn't bet on it, but we could be in a period of much higher valuations. However, I don't like guessing at too high future valuation multiples. Sure, I used 30 for Meta. Maybe you could use 30 here as well, and that would add another 50% total return over these 4 years. So that's about a 10% or 8% per year additional. So that would take us to about 20% total return per year. That might be reasonable, but on the other hand, this is a manufacturing company of sorts due to their connection to TSMC and the need for build out of actual factories to get their products out. So it would still be a bit worse prospect than Meta. Going back, looking at the entire mega cap segment, there are about 50 stocks with more than $200 billion valuation. Nvidia has the highest profit margin of them all, as you can see here, with a profit margin of 56%. Then there is a huge gap down to number 2, which is TSMC at 42%. This huge gap of profit margins is actually a risk. It's very difficult to keep that high margins, and it would be much more reasonable if Nvidia dropped by about 10 percentage points here, and that means we have a 20% risk to permanent profit level. As we can tell, some of the other super profitable and successful mega caps are Meta with 38%, Microsoft with 35% profit margin, Google with 31%, and look at Apple, typically a hardware company with just 24% margin. We can also compare the mega caps on gross margin levels, and then Nvidia is just at number 9 with a 75% gross margin. So in that respect, sure, it's not absolutely bleedingly high gross margins, but in terms of net margins, they definitely are at risk for more competition and clients actually looking for alternatives. And then finally we get to Alphabet. They too have numbers similar to the other companies. The recent growth rate has been about 50%. They exhibit a much more erratic long-term trajectory of growth, and the market is the market consensus stays here around some 10 to 15% per year. To me, that seems just way too negative. Again, there is something in the air about the looming recession and regulatory hurdles, not the least. The regulatory authorities are really starting to squeeze some of these big tech companies. The question is, will that actually materialize those risks? And I think Google has is one of the best most innovative companies in the world with the best staff. So I would actually bet that they will keep, let's say, a 20% growth rate rather than 15%. And I think that this regulatory risk that we're currently seeing is more of a temporary hurdle. And in a way, just making a few assumptions here. Let's say that they can land at 23 times earnings rather than 18 times earnings as they currently do, and based on a higher earnings per share projection, they would actually get to a 23% CAGR, which is good, not fantastic, but definitely good.